All right, a year ago today, the Dow plunged 777 points, the biggest one-day drop in history. We're still 5% under that fateful close even after this year's monster rally. But Paul Hickey, co-founder of Bespoka Investment Group, says that with credit conditions back to pre-Lehman levels, there is no reason stocks shouldn't follow. He joins us now. So, Paul, I suppose that puts you in the camp of the bulls. Let's talk about why. Why is it that we should think about stocks in the context of the credit markets?
Well, this whole crisis was centered on the credit markets, and so it was a credit crisis, as we've all heard a million times. And so the fact that all these credit market indicators, whereas back in December, people were saying these companies will never, that need to refinance their debt, will never be able to do it again. You know, their yields got up to 20% on junk bonds, and so suddenly those, and over the last 6 months, those spreads have come back into levels they were at prior to the collapse of Lehman Brothers. And so that, coupled with the strong economic indicators we're seeing, not strong at face value, but they continue to beat expectations at paces we haven't seen in at least 10 years.
Paul, what about all these people who say, we're up for September? We're never up for September, and that means there's just no way stocks can continue rallying for the fourth quarter.
Right. Well, September is up less than half the time. So the fact is, that we're up, we are, breaking the historical average a little bit. But we actually look back and looking at the fourth quarter performance when September is positive versus when September is negative. And when September is positive, the S&P has averaged actually a gain of about 6% in the fourth quarter, with gains about 80% of the time.
So for the end of the year, can you give us an S&P 500 target?
We don't do targets, but like an 1150 level is something where we could easily see the S&P get to. Again, it's not going to be a straight line here, but you will get corporate events and news to come. But unless something comes up to stop this trend and change what's been going on, I think we're going to get there.
One of the things you take a look at in your week in review is the breadth of the market. Explain to us why breadth is important right now.
Well, the fact is, when you see the market going up, technicians like to see strong volume, and they like to see more stocks going up. If only a few stocks are participating in the rally, it shows that the gains aren't really all that strong. And what we've seen is, over the last 50 days, the breadth of the market has gotten to levels where we've only seen 12 other occurrences where it's happened. So, and historically, going forward, that's been a positive for the market.
You're also watching the dollar and its relationship to the equity markets. What do you see?
Well, I mean, since the Fed came out and announced their rates last week, their rate decision, the dollar and stocks have been moving in exact lockstep with each other, or opposite directions. One move up in the dollar is a move down in stocks.
And we have that chart up on the screen.
And as long as that continues to happen, as long as the dollar is weak, I think that's the short-term trend for stocks should be good.
You think that correlation continues?
Yeah, we think it continues.
Okay, Paul. Thanks very much.
Thanks
Paul
for
Hickey
having
of
me.
Bespoka Investment Group.
Thanks.
We love it when he's here.
Yes, we do. Paul.